welcome to an episode of Fast 5. I'm your host, Brent Strantke, where I give you 5 quick market updates in less than 5 minutes. Today is Tuesday, October 7th. Let's get started. The first thing I want to talk about is the strength of the economy. The third reading of the second quarter's GDP here in the US came out much stronger than expected. This came out 2 weeks ago at 3.8%. That's well above trend. It's the highest growth rate in 2 years, and it suggests that the economy is growing at a faster rate than the last 10-year average. So from an economic perspective, growth looks pretty good. We'll see how that transposes into the third quarter, but I expect that momentum to continue. Second point on the economy, a very big important indicator here as we go forward is inflation. People were very concerned about what was going to happen with inflation because of tariff policy, and it seems like it's been more muted, much more muted than it was expected or feared. As of last month, when the data for August came out, it was 2.9% year over year, a little bit higher than the government's wish, but still very manageable. So it's been trending in that range, which is to say better than expected. To talk, the third point, what's going on in people's minds, of course, is the government shutdown. It's certainly in the news feed in the evenings, and I want to share just a little bit of background about this. First, the last one was in 2018, the last meaningful shutdown, so it was over 7 years ago. It lasted 35 days. That's much longer than the typical shutdown. And you can see on the chart here, we have the previous, the previous 6 since 1990. Of the previous 5 shutdowns, 4 of those were down. The stock market was down in the week leading up to it. Wasn't the case this time. Market was actually higher in the week going up to it. It seems like markets have kind of shrugged off, not really concerned, at least at the moment, going into the first full week of the shutdown. It's mostly seemingly about spending, of course, as you expect. The Democrats want to prolong the Affordable Care Act, which could mean that up to 4 million more Americans keep healthcare, according to the CBO. And the Republicans point to the $1 trillion cost over 10 years and the fact that those extensions were only meant to be temporary because of the COVID extension. So we'll see if that gets resolved anytime in the near future. And this final part I have about the government shutdown, listen, they're pretty common. You can pause here and take a look at the chart if you want to see how the markets have returned over this period. But there have been 50 shutdowns in the last 75 years. And 1 month later, on average, after the shutdown is over, markets up 1.2%. And 3 months later, on average, just simple averages, up almost 3%. So it seems like this is just a news concern and not actually a real concern here for the economy, if history is any indication. The fourth point I want to do is take a step back and kind of address some of the other things that are going on in the alternative investment marketplace. We've talked about stocks a lot, they're near all-time highs, but what about some other asset classes? So interestingly enough, one of the best performers through the third quarter, year to date, the first 9 months of the year, silver up 60%, gold up 47%, homes up 2.9%. We've seen a little bit of a slowdown in the home acceleration. Of course, mortgage prices are high with interest rates being higher. So that's maybe to be expected. One interesting point, oil. Did you realize gas prices, of course, have come down year to date? Oil prices down about 16% year to date. And coffee prices. If you're like me, I love my coffee. Just was surprised to see my Americano was over $5 at my local place. Coffee up about 20% year to date through the first 9 months of the year. So a lot of moving prices here in the marketplace. Finally, as usual, I just want to take a step back from all the nuance and noise out there and give an optimistic take. And I wanted to share that the market rally that we've had in the S&P 500 since the tariff concerns in mid-April, where the market was down 20% at its lows, the market has rallied over 30% since then. It's not usual for the market to rally that much in 5 months. It's only happened 5 previous times in the last 40 years. But on average, going forward the next 12 months, the mean return for the S&P 500 is 13.9%. What that means is that the momentum could continue into the next 12 months. So it might be a good indication of things to come. So those are the Fast 5 for us this week. If you have questions or concerns, please let me know.